Nike continues on its path to becoming a digital-focused retailer, and that's an announcement that sent Foot Locker shares crashing. However, with the continuation of this strategy, is it time to purchase Nike's shares? That's what we're going to dive into in this video. So smash that like button and subscribe if you're new. You're watching More Money. Let's get it. What's up, guys, and welcome back to the channel, where the purpose here is to help over 1,000 people achieve financial independence much sooner. And let's dive right into it. So you can see here that Nike is actually expected to open a technology center in Atlanta as it continues to focus down on its digital direct-to-consumer strategy. And you guys may remember from the Foot Locker video that I did do on this channel that Nike's direct-to-consumer sales as a percentage of its total brand revenue has more than doubled over the past 10 years, and they're looking to get this past 50% over the next few years. And so in order to get past that 50% range for digital sales, they're focusing on what's called a consumer direct offensive strategy. And what exactly is that? Well, you can see here, it's completely changing their business model and shifting away from the lagging wholesale distribution business towards their high growth direct sales to consumers business. And this is what crushed Foot Locker's shares. And so how are they doing it? Well, over the past few years, you can see here that Nike has actually terminated many long-term wholesale partners, including Macy's, Urban Outfitters, Shoe Show, Durham Sports, Dillard's, Fred Meyer, and Zappos. They also ended a high-profile partnership with Amazon. Think about that. Nike is so successful at their digital strategy that they don't even need Amazon. That's strength, guys. And so instead of working with these partners, Nike is focusing the majority of its efforts on its direct-to-consumer strategy. And so they describe that direct-to-consumer strategy by doing the following, which is accelerating their innovation and product creation, moving closer to customers by growing operations in 12 key cities across 10 countries, and deepening the one-to-one connection with interactive experiences across different channels. And that's a lot of corporate speak, but I think there's two real items that drives Nike's strategy here. One is exclusivity of particular launches on their websites, and two, making sure that it gets to the customer as quickly as possible, and the fulfillment of returns is as seamless and easy for customers as it is for Amazon customers. And so in 2020, the company launched the Consumer Direct Acceleration Initiative. And what they're really describing here is an omni-channel experience. So you have physical store concepts such as Nike House of Innovation, Nike Rise, Nike Live, and Nike Unite, as well as the online experience as well. And so they expect to continue to invest in their digital capabilities, but also check this out. This is really cool. They're going to be focusing on demand sensing, insight gathering, and inventory management. And it's that demand sensing which is pretty interesting because Nike is located all over the world. So it would make a lot of sense to invest in algorithmic technology to understand exactly what markets are demanding what at what time. I think that's just really good next level digital retailership. But one thing that I did notice when I was looking at the model for Nike as I was building out the valuation is that although their direct-to-consumer sales have been going up, their margins have relatively stayed the same. So you would expect that as they go more direct-to-consumers, their margins would actually increase. That's not been what's happening. So what I expect is that they're really going to do something to juice up those margins. And I think the first thing is a reorganization within the company. And so you can see here that Nike actually plans to cut jobs as they sell more directly to customers. So their chief executive officer, John Donahue, who's a longtime Silicon Valley executive, took the helm at Nike in January of 2022, and he announced a new phase in the e-commerce push, which is called the Consumer Direct Acceleration, which is what we just mentioned. And so what they're expecting to do is shift resources and create capacity to reinvest in their higher potential areas, which obviously includes a realignment, which will result in the net loss of jobs. So in other words, they're going to try to juice up the margins in their business by getting rid of the less value added roles in the business. And so this is what I'm talking about. You can see here that the sales through direct to consumer increased from 50.3% in 2012, and they reached 38.5% by 2021. But notice how there's been no margin improvement. It was a 43.5% gross profit margin in 2012, and it's only a 44.8% gross profit margin in 2021. And part of that is just product mix and demand, but it's effectively around the same area. I would have expected that if they more than doubled their direct to consumer sales, their margins would be closer to like 60%. So the fact that that didn't happen really rang a bell for me, which is why I started searching to see what they would be doing about the margins. And lo and behold, it looks like they were way ahead of me. They had already announced one of their initiatives that they were going to take. Now, look, there's going to be more initiatives to bring this profitability up. I guarantee it. But with that said, you can see here in my model, by 2027, I'm forecasting that they're essentially getting to approximately 50% of direct-to-consumer sales. And so I think that's very important because it allows them to reach a milestone. Now, I actually think that they get there much sooner, but I'm just being a little bit conservative here. And from my valuation, you can see that I'm valuing the company at approximately $79 per share, but note that I haven't given them that margin expansion. I want them to prove to me that they can accelerate that margin before I give them credit for it in the valuation. So there's a lot of upside to this valuation that I'm just not building in right now. But once again, if you're a Patreon, download the model, adjust the profitability, and see what sort of valuation you get. And then ask yourself, do you believe that management is capable of driving this type of profitability improvement? And of course, you can get access to this Nike model at the $5 a month Patreon tier. And you guys already know, if you subscribe and you don't like it or you don't find value from it within the first month, just let me know. No questions asked. I'll fully refund your money. There's zero risk for you for trying this out. And you guys did hear me mention that Foot Locker shares absolutely crashed. So the question is Foot Locker a value opportunity right now? I dive into that in this video right here.